Okay, let's unpack this today. Because I think we all know that specific feeling. You know, it usually hits around 3 in the morning on a Tuesday.
Oh, yeah. The universal 3 a.m. panic. It's practically a human tradition at this point.
It really is. You wake up, you're staring at the ceiling fan spinning in the dark, and suddenly your brain decides, hey, it's the perfect time to audit your entire life.
Right. Just completely out of nowhere.
Yeah, but it's not just, vague existential dread about the universe. It's highly specific. It's that gnawing feeling in the pit of your stomach about money.
Yep. The financial anxiety.
Exactly. And not just, do I have enough cash for a coffee tomorrow morning, but the big stuff, the future, the debts, the retirement that we probably haven't planned for.
It is so pervasive. I mean, it keeps millions of people up at night. And today, we are going to stare that exact anxiety right in the face. We're zooming in on a very specific beast, which is the United States financial system.
And a beast is really the right word for it, because for a lot of people, and I mean, even people who grew up in the States, this system feels like it's almost designed to confuse you.
Totally.
It feels like it's written in a foreign language.
That's a great way to put it. And actually, the source material we are diving into today comes from that exact perspective. We're analyzing a really fascinating conversation from the Learning English podcast with hosts Emma and John.
Right.
And they titled their discussion, Cracking the Code of American Finance. And I think that word code is doing a lot of heavy lifting there.
It definitely implies a secret, doesn't it? Like something you actively have to decipher to survive.
Exactly. And right off the bat, Emma and John established their premise. They say the U.S. financial system is, and I quote, daunting.
Daunting. That is such a heavy, heavy word. It doesn't just mean hard.
No.
It means intimidating. It means something that kind of looms over you like a mountain you have to climb, but you realize you don't have the right shoes for it.
And what's really fascinating in their breakdown is that they emphasize this isn't just a problem for immigrants or newcomers to the country.
Right.
Even native speakers, people who were born right into this machinery, find it incredibly overwhelming. They use a specific metaphor in the source that I think frames our entire deep dive today perfectly.
Yeah.
They call the system a labyrinth.
A labyrinth. I love that image. Because it's not a straight line from point A to point B.
No, it's a maze.
It's a total maze.
Right. It's this complicated, highly irregular network of passages. You walk in, you think you're heading toward, financial freedom, and then suddenly, boom, you hit a dead end.
Or you turn a corner and there's just a trap door waiting for you.
Exactly.
And the walls of this labyrinth, they are built out of acronyms. That's what really jumped out at me in the notes from the source. You walk in and you're immediately assaulted by all these letters.
The alphabet soup.
The alphabet soup, 401k, IRA, APR, FICO. It's just this jumble of letters that can literally cost you thousands of dollars if you don't know what they stand for.
And that is the true danger here. In a physical labyrinth, if you take a wrong turn, you just get a little lost. In the financial labyrinth, if you take a wrong turn, you lose your savings.
Yeah.
You pay huge penalties. You get denied a home. The stakes are incredibly real.
So that is our mission today for you listening. We are going to map this maze. The expert in our source material frames the primary goal as transitioning the listener from feeling overwhelmed to actually understanding the rules of the game.
Because it really is a game.
Yeah.
A high-stakes game, absolutely, but a game nonetheless. And once you know the rules, once someone hands you the map, the labyrinth stops being this scary monster and just becomes a system you have to navigate.
We're going to break this down into the 3 main pillars that we found in the material. Because if you understand these 3 specific things, you can survive the maze.
Right.
We were talking about credit scores, retirement funds, and budgeting.
And whether you are planning to move to the U.S. soon, or you're already living there, or maybe you just want to understand what on earth characters in American movies are talking about when they start stressing out over their FICO score.
Which happens a lot in movies.
It does. This deep dive is going to clarify all that chaos for you.
So let's stop standing at the entrance looking scared. Let's actually step into the maze. The very first thing we encounter the monster guarding the entrance, essentially, is the credit score.
The ultimate gatekeeper.
Yeah.
You cannot really exist in the American financial system without dealing with this specific entity.
The source material is brutally honest about this part. The host in the podcast asks, what's the first hurdle? And the answer is immediate. It's this mysterious 3-digit number that dictates one's life.
Dictates one's life. It sounds a bit dramatic, almost like something out of a dystopian sci-fi novel, but it is entirely accurate.
But why? I mean, think about it. In a lot of places around the world, if I have money, I have power. If I walk into a bank in, say, certain parts of Europe or Asia, and I literally have a suitcase full of cash, I'm a VIP. The bank loves me.
And that's the crucial distinction our source makes. In many cultures, your quote-unquote creditworthiness is based entirely on your current assets and your personal relationship with the bank manager.
Yeah, they know you.
Exactly. They know your family, they see your balance, they trust you as a human being. The U.S. system is entirely different. It's highly impersonal. It relies on what the source calls a numerical expression of reliability.
A numerical expression of reliability. So the system fundamentally doesn't care if I'm a nice guy.
It does not care at all.
It doesn't care if I promise my mom I pay my bills on time. It only cares about the math, the number.
Precisely. You are reduced to data points. An algorithm looks at your historical behavior and assigns you a rank. And that rank, your credit score, typically ranges from 300 to 850.
300 to 850. Okay, so if I'm sitting at 300, I'm in serious trouble. If I'm at 850, I'm golden. But what actually moves that needle up or down? Is it just how much money I make at my job?
No, and that is a very common misconception that trips people up. You could technically be a millionaire with a terrible credit score, and you could be earning minimum wage with a perfect score.
Wow.
Really? Really? Right. Because it's not about wealth. It's about behavior. The source breaks it down into three main mechanics. First up is debt levels.
Okay, so how much I currently owe.
Right, but specifically how much you owe relative to how much you could borrow. The industry term for this is utilization. So if the bank gives you a credit limit of $10,000 and you've currently spent $9,900 of it, you look incredibly risky to the algorithm.
Because I'm maxed out.
You're maxed out.
You're basically walking right on the edge of the cliff.
Exactly. You have no buffer.
Yeah.
The second factor, and this is arguably the single most important one mentioned in the text, is bill payment punctuality.
Punctuality. Now, usually when we hear that word, we think about showing up to a dinner party on time.
Right. Not keeping your friends waiting.
Yeah. But in finance, punctuality is everything, isn't it?
It is the whole ballgame. The question the system is constantly asking is, when you receive a bill, do you pay it on the due date? Not a day later, not a week later, on time.
So what happens if I miss a payment? Just one.
It's an absolute disaster for your score. It's not treated as just an oops, I forgot. It's a massive red flag that basically screams to the algorithm, this person is unreliable right now. And that negative mark can stay on your public record for years.
Years. Just for one missed payment on a credit card.
The system has a very, very long memory. That's why the text emphasizes punctuality so heavily. You cannot miss the due date. And that actually leads to the third factor, which is the length of your credit history.
Which basically means how long have you been playing this game?
Correct. A 10-year history of paying your bills on time every single month is worth vastly more than a 6-month history. It proves long-term stability.
Okay, so we kind of know how the machine works on the inside, but let's talk about the real-world stakes. Why should you, the listener, care about this? If I have a low score, can't I just say forget it and use cash for everything?
You can certainly try. But the entire U.S. infrastructure is built on credit. The source outlines the real-world consequences very clearly. If you have a high score, let's say you're sitting at 750 or 800, the doors of the labyrinth just open for you.
Life gets easier.
Much easier. You apply for a nice apartment, approved immediately. You want to buy a car. The dealer says, here's a loan with a 3% interest rate.
So life is literally cheaper for you.
Significantly cheaper. But if you have a low score, the labyrinth walls just close right in on you.
Yeah.
The source explicitly mentions the denial of apartments.
Yeah.
Just imagine having enough cash in your bank account for the rent, but the landlord flat out refuses to let you sign the lease because your 3-digit number is too low.
That feels incredibly unfair.
It feels very personal when it happens, but to them, it's just the algorithm protecting their investment. And if you do somehow manage to get a loan, say for a used car, just so you can physically get to work, you face what the source calls exorbitant interest rates.
Exorbitant. I really love that word. It just sounds expensive when you say it.
It perfectly captures the reality. It means unreasonably high. It means while the person with a good score pays maybe $300 a month for that car loan, you might pay $500 a month for the exact same vehicle solely because the bank sees you as a mathematical risk.
It's expensive to be poor, or at least it's highly expensive to have bad credit.
That is the harsh reality of the gatekeeper. But here is where it gets really interesting and honestly a little mind-bending for people new to it. The source brings up a specific idiom to describe the plight of someone entering this system for the first time. The catch-22.
Oh, I loved this part of the material, the catch-22. It's such a classic logical trap.
It originated from a novel, but in the financial world, it's a very real brick wall you hit. A catch-22 is fundamentally a dilemma where you absolutely need the very thing you are trying to get in order to get it.
So let's play this scenario out so we can really see it. I'm new to the US. I walk into a bank branch. I go up to the teller and I say, "Hello, I would like a credit card to prove that I am a reliable person."
And the banker types away on their computer, looks up, and says, "I'm sorry, I can't give you a credit card because you won't have any credit history."
And I say, "Right, exactly. That's why I want the card, to build the history."
And they smile and say, "But sir, we can't give you the card until you have the history."
It's a loop. It's a completely closed circle. You can't get in because you're not already in. It feels like a prank.
It is the ultimate paradox. And for millions of people, honestly, this is the exact spot where they just give up. They surrender. They say, fine, I'll just use cash and debit cards. But then, fast forward 10 years, they can never buy a house or get that cheap car loan. They stay permanently trapped in the expensive, difficult part of the labyrinth.
But thankfully, our source material offers a key, a way to actually pick the lock on this gate. They mention a tool called the secured credit card.
Yes, this is the hidden door in the wall. This is how you break the loop.
How does it actually work? Because it sounds, well, the word secured sounds safe, but what does it practically mean for the person walking into the bank?
Think of it as a credit card with training wheels, or essentially a credit card that you fund yourself. To get one, you have to give the bank a cash deposit up front. Let's say you hand them $500 of your own hard-earned cash.
Okay, so I hand over $500.
The bank takes that money and holds on to it. It's called collateral. It acts as their insurance policy. If you rack up a bill and run away, they don't care because they just keep your $500. Because they have that safety net, they're willing to give you a credit card with a $500 spending limit.
So wait a minute, let me get this straight. I'm basically just borrowing my own money.
In a purely mathematical sense, yes. You give them $500, they let you spend $500. It seems entirely redundant. You might think, why not just spend the cash in the first place?
Right, why jump through this bizarre hoop?
Because of the reporting. That is the magic word. When you use that secured card to, say, buy your weekly groceries, and then you pay the bill off completely at the end of the month, the bank reports that their responsible activity to the major credit bureaus. They ping the system and say, hey, algorithm, this person paid on time.
Ah, I see. So you are essentially paying for the privilege of generating data.
Exactly. You are artificially manufacturing a credit history from scratch. You do that carefully for 6 months or a year, and suddenly, boom, you have a real credit score. The algorithm trusts you now. The bank gives you your original $500 back, and they upgrade you to a normal, unsecured card. You've officially broken the catch-22.
That is such a crucial hack to understand. You are literally playing the game just to prove to the system that you know how to play the game.
And that is how you get past the gatekeeper.
Okay.
Once you do that, you have access. You are in the maze. But now you have to look down the really long hallway. You have to start looking at the future.
Segment 2, future-proofing. We are talking about retirement vehicles. And I have to say, if the credit score segment felt like a hurdle, this section is where the alphabet soup really, really gets thick.
It does. It gets dense fast. And we have to start with the big one, what the source calls the quintessential American retirement vehicle, the 401k.
401k. I just have to stop us here for a quick second. Who on earth named this thing?
It's awful, isn't it?
It sounds like a robot from a bad sci-fi movie or like a highway exit. You know, take the 401k west to the financial district.
It is genuinely terrible branding. It's literally just named after the specific section of the U.S. Internal Revenue Code subsection 401 paragraph K that legally allows the account to exist. It is pure, unadulterated, bureaucratic naming.
So if we strip away the incredibly boring name, what is this thing actually doing for you?
The source formally defines it as an employer-sponsored pension account. But the daily mechanics are what actually matter to you. It's a special account that allows you to divert a portion of your current income directly into investments, and you get to do this before the government taxes that money.
Pre-tax, that's the critical phrase the source uses here.
Right, pre-tax. So let's do the math. If you earn $1,000 this week at your job, and you tell your employer to put $100 into your 401k, the government steps in and only taxes you as if you earned $900. You are actively lowering your taxable income today in order to save for tomorrow.
That's a pretty nice perk. It's almost like hiding money from the tax man, but doing it completely legally.
Exactly. You are shielding it. But the real power, the thing that Emma and John in the source material really hammer home for their listeners, isn't actually the tax break. It's a feature called the match.
Okay, the match. This is the part of the transcript where my ears really perked up. Because usually in the financial labyrinth, nobody gives you anything for free.
That is the golden rule of finance, usually. But the 401k employer match is the rare exception. The source explains it like this. Many employers, as an incentive, will match your contribution up to a certain percentage of your salary. So, for example, if you elect to contribute 3% of your salary into the 401k, the company will also put 3% of their money into your account.
So let's just use round numbers to make it clear. If I put in $1 for my paycheck,
They put in $1 of company money
that's a 100% return on your investment instantly.
instantly,
Yeah.
the very second it hits the account. There is no other legal investment in the world that guarantees a 100% return on day one. The source frames this very, very bluntly. They call this free money.
Free money. I almost feel like we should have a giant bell or a sound effect for that phrase. It's so jarring to hear in a finance context.
We really should, because it is incredibly rare. And that's exactly why the expert in our text gives such a stern, almost dire warning about this. They use a great idiom here to describe what happens if you ignore this. Leaving money on the table.
Leaving money on the table, it's a highly visual idiom.
Imagine you just finished a long poker game, you've won the final pot, the huge pile of chips is sitting right there in front of you, and you just stand up, put your coat on, and walk out the door.
Yeah.
You literally leave your winnings sitting on the green felt.
That's insanity. Literally, no one would ever do that.
And yet, millions of American employees do it every single year. They don't bother to sign up for their company's 401k, or they sign up, but they don't contribute enough of their own money to trigger the full employer match. They're sitting there working 40 hours a week for the company, earning the salary, but actively rejecting the bonus cash.
It's effectively volunteering to take a pay cut. You are choosing to be paid less than the colleague sitting in the cubicle next to you just because you didn't fill out a form.
That is the exact mindset shift the source is pushing for. You have to start seeing that match not as a perk, but as part of your base salary. If you don't take it, you are basically donating your own salary back to a massive corporation.
Okay, I'm sold. I'm taking the match. Give me the free money. But here is the necessary reality check for a lot of people listening. Not everyone has a shiny corporate job with an HR department and a 401k program.
Right.
What if I'm a freelance graphic designer? What if I'm driving for a rideshare app? Or what if my company is just a small mom and pop shop that doesn't offer a retirement plan?
Yeah.
Am I just locked out of the future?
The source definitely anticipates this question.
Yeah.
The labyrinth always has other paths if you know where to look. And that brings us to the next big acronym in the soup, the IRA.
The individual retirement account.
Yes. And specifically, the source zooms in on one very popular flavor of this account, the Roth IRA.
The Roth. Now, how does this actually differ from the 401k we just talked about?
It completely flips the script on how taxes work. Remember how the 401k was pre-tax? You get the tax break right now on today's paycheck.
Right. I had the money today.
The Roth is post-tax. So you get your paycheck, the government immediately takes their cut just like normal, and then you take the cash that's left over and invest it into the Roth account.
Wait a second. So I pay the taxes today? That genuinely sounds worse. Why on earth would I volunteer to pay the taxes right now when I could defer them?
Because of what happens on the back end. It's a delayed gratification play. Think of it like farming. With a traditional 401k, you don't pay any taxes when you buy the seeds, but the government taxes your massive harvest decades later. With a Roth, you pay the tax on the tiny handful of seeds today.
But the entire harvest is tax-free.
Completely, 100% tax-free. When you finally retire and start pulling that money out in 30 or 40 years, the government legally cannot touch a single cent of the growth.
And if the stock market does what it's historically supposed to do over 30 years, that harvest is going to be exponentially bigger than the initial seeds you planted.
Exponentially.
Yeah.
And that brings up the underlying power of all these vehicles, which the source identifies as the true engine of wealth building. Compound interest.
Compound interest. Albert Einstein supposedly called it the eighth wonder of the world. Right?
He did. It's the concept of your money making money,
Yeah.
and then that new money making even more money. The source emphasizes heavily that winning this game is all about time in the market. It's not about day trading or trying to perfectly time when to buy and sell. It's about starting as early as possible and just letting that snowball roll down a very long hill for decades.
Okay. So we have the 401k if we want that free money match from the boss. We have the Roth IRA for that beautiful tax-free exit in our 60s. That's how we secure the long-term future. And in finance, there's always a but.
The but is always today.
Right. It's fantastic to know I'm going to be rich when I'm 65. But I have to eat lunch today. I need to pay my landlord today.
And that reality brings us right to the third pillar of the labyrinth, the daily grind. Segment 3, budgeting frameworks.
Now, I appreciate that the source sets the stage here by acknowledging the current economic reality. We aren't making a budget in a vacuum. We're trying to budget in an economy dealing with inflation and constantly rising costs of living.
It's just getting incredibly expensive to exist. The price of eggs goes up, the price of gas fluctuates, the daily friction on your wallet is very real.
So how do we actually manage the daily cash flow without completely losing our minds? The source outlines a very specific, very popular framework for allocating your after-tax income. They call it the 50-30-20 rule. Let's break down these 3 buckets for the listener, because it sounds like a sports play. First up, the big bucket, the 50%.
This is dedicated to your needs, capital N. The source lists these as the absolute non-negotiables in your life. Housing, groceries, basic utilities, the things you literally cannot survive without.
So half of your entire take-home pay goes purely to survival, essentially, just keeping the lights on and the roof over your head.
Survival and baseline stability, that's the foundation.
Then we move to the fun bucket, the 30%.
This is for your wants. The source lists things like dining out at restaurants, entertainment, your streaming subscriptions.
The famous latte factor.
Exactly. The morning latte, the Netflix account, the weekend road trip. This is entirely the lifestyle bucket. It's what makes life enjoyable.
And finally, that leaves the remaining 20%.
This last bucket is strictly for savings and debt repayment. This is the bucket that actually builds your future. It's the money you use to fund that Roth IRA we just discussed, or the money you use to aggressively pay down that credit card balance so you can fix your credit score.
It sounds so tidy and perfect, doesn't it? 50, 30, 20, just slice the pie into 3 neat pieces and you're good to go.
Huh.
But before we critique how realistic that is, the source introduces some really colorful language here to describe the ultimate goal of managing this budget.
Yes, the idioms of profit and loss, the colors, in the black versus in the red.
I use these phrases all the time in normal conversation, but I realized reading the source that I never actually thought about where they came from.
It's a great historical callback. It comes from the old days of physical accounting ledgers, way before software and computers. Accountants used actual inkwells. If a business was profitable, if they actually had money in the bank, the accountant would write the positive numbers in black ink.
So being in the black is the goal. It means you are solvent, you have cash.
Exactly. But if the business was losing money, if they suddenly owed more than they brought in, the accountant would literally switch pens. They used red ink to highlight the negative balances so they stood out on the page.
So being in the red means you are in debt. It's danger.
It's a blaring warning signal. So the fundamental goal of the 50-30-20 rule, or really any budgeting framework you choose to use, is simply to keep your personal ledger in the black.
But here's where the source offers a much-needed reality check. And I really appreciated this part of the deep dive because it didn't feel like a sterile textbook lecture. It felt like real life. The host and the source actually challenges the rigidity of the 50% rule for needs.
They do. They bring up geography. Specifically, high cost of living areas.
The New York problem, or the San Francisco problem.
Right. Because if you live in Manhattan or downtown San Francisco, or frankly, any major metropolis these days, good luck trying to keep your total housing costs under 30% of your income, let alone keeping all your combined needs under 50%.
Rent alone can easily eat up 50, 60, even 70% of a paycheck in those cities.
The expert in the source openly admits this flaw. They say that in those specific geographic areas, the rigid mathematical framework of 50-30-20 just breaks down. The math simply does not work for an average earner.
So what are you supposed to do? If the golden rule says 50%, but reality says your rent is $3,000, do you just throw your hands up and give up on budgeting entirely?
No, you have to adapt the framework. You have to be honest and acknowledge that if your needs bucket is overflowing at 65% of your income, your wants bucket absolutely has to shrink to compensate. That 30% might have to become 15% or 10%.
That is the truly painful part of personal finance, the trade-off.
It is painful. But ignoring the math is ultimately much worse. If you are forced to spend 60% on needs and you still stubbornly try to spend 30% on wants just to keep up with your friends, you inevitably end up
In the red.
in the red. You start using credit cards to bridge the gap, the exorbitant interest kicks in, and that's where the labyrinth completely traps you.
So we have the budget as our daily navigation system.
Yep.
But life is chaotic, it's messy, tires blow out on the highway, people get sick unexpectedly, whole companies downsize, and jobs get lost.
And that harsh reality brings us to the safety net. Segment 4, the emergency fund,
The source affectionately calls this the rainy day fund.
which is such a gentle, almost poetic phrase, isn't it? Rainy day.
It really is. It sounds like a cozy Sunday where you stay inside, make some tea, and read a book. But in the context of finance, a rainy day is a Category 5 hurricane ripping your roof off.
It is a full-blown crisis. And the source defines building this fund as a top priority. Before you start worrying about aggressive stock market investing, before you try to buy crypto or save for a fancy car, you need to build this stash of cash.
How much money are we actually talking about here? What's the target?
The standard recommendation laid out in the text is 3 to 6 months of total living expenses.
3 to 6 months. Let's think about that. That's a highly significant chunk of change. If your baseline life costs $4,000 a month to run, that means you need up to $24,000 just sitting there doing nothing.
And sitting there is the absolute key phrase. The source specifies very clearly that this money must remain liquid.
Liquid. Let's unpack that term for the listener, because obviously we aren't talking about pouring water into a piggy bank.
Right. Liquidity in finance refers to how quickly and easily you can turn an asset into spendable cash without losing value. Cash sitting in your checking account is 100% liquid. You can spend it in 5 seconds.
Whereas a house is not liquid at all.
Exactly. A house is what we call a frozen asset or an illiquid asset. If you lose your job on a Tuesday and you urgently need to buy groceries on Wednesday, you can't just shave a brick off your chimney and hand it to the cashier at the supermarket. It takes months to sell a house and access that wealth.
What about a car? If I have a really nice car, is that liquid?
Still no. You'd have to find a buyer, negotiate, transfer the title. It takes days or weeks. So the emergency fund needs to be in a plain, boring savings account, highly accessible, totally liquid.
Because when the emergency hits, it hits fast. You don't have time to liquidate assets.
Precisely.
And why is this safety net so incredibly critical in the U.S. system specifically? Because the source makes a very pointed, very specific observation here about the risk landscape in America.
It connects directly back to the healthcare system. The source mentions standard risks like job loss or a broken down car, sure, but it specifically highlights medical emergencies as the primary threat.
And it describes U.S. healthcare costs with a very strong word, astronomical.
Astronomical, space-level costs, meaning costs so high they're almost hard to comprehend.
It's sad, but it's true. In many developed countries, if you fall off a ladder and break your leg, it physically hurts your leg. In the U.S., if you break your leg, it physically hurts your wallet. It can literally bankrupt a family.
A single 10-minute ambulance ride can cost thousands of dollars out of pocket. A relatively routine surgery can run into the tens of thousands. If you don't have excellent insurance, or honestly, even if you do have insurance but you have a high deductible plan, that hospital bill hits your mailbox like a runaway freight train.
And that is the true purpose of the liquid emergency fund. The source uses a great idiom here to describe its function, to cushion the blow.
Cushion the blow. It's a highly tactile image. The reality is you are going to fall at some point. Bad things just happen in life. The emergency fund doesn't magically stop the fall. You still broke your leg. You still got laid off from your job.
But it completely changes the landing.
Exactly. Instead of falling off the ladder and landing on solid concrete, which shatters your finances, you land on a giant thick mattress. It turns a life-ruining financial disaster into a temporary inconvenience. And that, really, is what true financial stability is. It's not about miraculously preventing problems. It's about having the resources to survive them without going in the red.
Okay, so we have covered the heavy mechanics of the labyrinth. We have the credit score to get past the gatekeeper. We have the 401k and the Roth IRA to protect the distant future. We have the 50-30-20 budget to manage the daily flow of cash. And we have the liquid emergency fund to catch us when we inevitably fall.
Those are the physical tools you need in your backpack. But the source material does something really interesting at the end. It shifts gears. It moves away from the hard mechanics and dives into philosophy.
Yeah, segment 5, the philosophy of financial literacy. Because I guess you could memorize all these definitions, ace a vocabulary test on acronyms, and still be totally terrible with your actual money.
Absolutely. You see it all the time. The source makes a really crucial distinction here between the act of earning and the act of managing.
Unpack that distinction for us. Why are those different?
The source argues that being financially literate isn't just about grinding to get a high salary. People confuse the two. You can make $1 million a year. We see this with lottery winners or newly drafted pro athletes constantly. They get handed millions of dollars, and 3 years later,
They are completely broke. They are deep in the red.
because they earned $1 million, but they spent $1 million and won. Financial literacy is entirely about how you manage what you actually keep. It requires a fundamental mindset shift. It's moving from being a passive earner who just spends what enters the checking account to an active manager of your resources.
And this mindset shift comes with its own specific vocabulary of behavior. The source spends some time discussing the profound difference between being frugal and being cheap.
Oh, this is a dangerous nuance.
Yeah.
People use these two words interchangeably on conversation all the time, but they represent very different worldviews.
They really are different. The source explains that being frugal is a positive trait. It means being sparing or highly economical with your resources. It implies a certain kind of wisdom.
Right. It means saying, I'm consciously choosing not to buy this $5 coffee every single morning, not because I hate coffee, but because I want to put that $150 a month toward my travel fund.
It's about prioritizing what matters to you.
Exactly. Cheap, on the other hand, has a heavily negative connotation in English. Cheap implies a lack of care for yourself or others. Cheap means you go out to dinner with friends and refuse to tip the hardworking waiter to save $5.
Yeah, nobody likes cheap. Or cheap means you buy the $20 shoes that fall apart in a week because you stubbornly didn't want to spend the extra $10 for the high-quality ones that last for years.
Perfect example. Cheap is ultimately short-term reactive thinking.
Yeah.
Frugal is long-term strategic thinking.
And another related word the source highlights is prudent. Being prudent with your investments.
Prudence suggests foresight. It means acting with care and thought for the future. You don't dump your life savings into a random crypto coin your neighbor mentioned. You prudently invest in a diversified Roth IRA.
So the ultimate goal of decoding the system isn't necessarily just to be rich. It's to become prudent, frugal, and financially literate. That is the actual armor you have to wear to survive in the labyrinth.
That is the only safe path through the maze.
Okay, let's do a quick recap before we wrap this up. We have thrown a massive amount of vocabulary at our listeners today. Let's condense the map for them.
Good idea. Let's hit the major landmarks one more time. First, creditworthiness. That all-important reliability score that opens doors, you build it by paying every bill on time and utilizing stepping stones like secured credit cards.
Next, the match. The literal free money from your employer in your 401k account. The absolute golden rule here. Never, ever leave it on the table.
Then, keeping your ledger in the black. That is the core goal of your 50-30-20 budgeting. Keep your needs, your wants, and your savings balance so you stay consistently profitable.
And finally, the emergency fund. That crucial liquid cushion against life's astronomical, unexpected surprises.
If you can just master those core concepts, the U.S. financial system becomes vastly less of a monster trying to eat you and more of a powerful tool you can wield.
The source frames this whole learning process as an investment in yourself, which is so true. Just like taking the time to learn a new language, taking the time to learn this financial code pays massive dividends over your lifetime.
Absolutely. It transforms your daily anxiety into actual agency.
Yeah.
You stop constantly reacting in fear to the system, and you start making the system actively work for you.
I love that framing, from anxiety to agency. Now, as we finally close out today's deep dive, I want to leave you, the listener, with the really provocative thought that the source material ended with. It's a deeply personal question about that 30% bucket, the wants bucket.
That's a great question. It's really a question of core values.
The host in the source material asks, in your own personal financial life, if you had to choose, would you prioritize travel or would you prioritize dining out?
On the surface, it sounds like a simple, fun preference question. But it goes way deeper than that.
It does. It asks you to examine how that specific choice reflects your own personal definition of wealth. Is your version of wealth built on experiences? Is it having a passport totally full of stamps and memories?
Right. Or is your version of wealth rooted in daily comfort? Is it the joy of having a really nice, expensive meal with your close friends on a Friday night after a hard week?
And then the beauty of it is, there is no wrong answer. That's the trick.
There isn't. But you have to actually know what your answer is. Because if you genuinely value travel and world experience above all else, but you absent-mindedly spend all your discretionary money on daily takeout coffee in local restaurants, you aren't living in alignment with your values. You're just leaking money.
You have to consciously align your spending with your soul. That is deep.
It really is. But it's the only way to build a personal budget that you won't resent and one that you can actually stick to long term.
Definitely something significant to chew on this week. Thank you for diving so deep with us today into the labyrinth of American finance. Hopefully, we've handed you a working flashlight and a decent map.
It was an absolute pleasure to decode it all with you.
Until next time, keep exploring the maze.
And always stay in the black.
See you then.
Welcome back to the deep dive. Today we are doing something a little different, and honestly something that I think is going to be incredibly useful for pretty much everyone listening to us right now.
Yeah, absolutely.
We aren't just summarizing a topic today. We are really trying to decode the operating system of the American economy, I guess you could say.
That is a very high-stakes way to put it, but
Yeah.
you're not wrong. We are looking at the actual mechanisms of U.S. personal finance. It is the engine under the hood of your daily life.
Exactly. We're diving into a comprehensive breakdown of those twin pillars that pretty much hold up your entire financial life. So that's investing and taxes.
Right.
And I know what you're thinking out there. You hear the word finance and your eyes just glaze over. Or you hear taxes and your blood pressure immediately spikes.
Oh, yeah. It's usually either totally boring or absolutely terrifying.
Usually both at the same time, right?
Exactly.
But the material we have today, this is specifically a detailed Part 2 discussion between two individuals named Emma and John, and they really know their stuff. They break this down in a way that is actually digestible.
They do a great job of navigating the complex vocabulary.
Yeah, the concepts of Wall Street and Uncle Sam. They are effectively translating it from that dense financial speak into very clear, actionable concepts.
And that translation is the critical part of their discussion. The mission of this deep dive isn't just to list out definitions for you. We aren't here to just read a dictionary.
Great. Nobody wants that.
No, exactly. The goal is to understand the language of wealth. Because what is fascinating here is that finance is full of these idioms and metaphors and structural realities that really define how people interact with the American economy.
If you don't speak the language, you're basically flying blind.
You're just guessing at that point.
It feels like a completely foreign language to so many people. I mean, you watch the news and they throw around terms like mitigation and liquidity and amortization.
And normal people just nod along.
Yeah, they nod and just hope they don't get asked a follow-up question at a dinner party.
Definitely.
But once you actually crack the code, it changes everything. So today, we're going to see why we talk about animals, specifically bulls and bears, when we discuss money.
That's a fun one.
And we're going to find out why Albert Einstein reportedly called interest a wonder of the world. And then we'll look at why the date, April 15th, is literally etched into the collective memory of the United States.
It's quite a journey, really. From the optimism of wealth building, which is obviously the fun part.
The very fun part.
Right, to the inevitable administrative burden of the IRS, which is the friction. It really covers the full spectrum of the financial experience.
Okay, so let's unpack this. We are basing this deep dive on that specific conversation between Emma and John. And this is pitched at an advanced level, so they cover everything from market trajectories to the dreaded tax audit. Let's start exactly where they start.
Which is with the public image of investing.
Right. The perception gap is what I'm calling it. When Emma and John start talking, Emma points out that when most people hear the word investing, they have a very specific image in their heads.
Oh, absolutely.
It's basically Leonardo DiCaprio in a bespoke suit, right?
Right. It's the Wolf of Wall Street.
Yeah.
Or it's the chaotic floor of the New York Stock Exchange.
Exactly. Absolute chaos. People in sharp suits shouting into telephones, waving papers around. You've got those tickers flashing red and green everywhere.
High-stakes gambling where fortunes are just made or lost in a single second.
It's very dramatic. Adrenaline pumping. It's kind of sexy in a chaotic way.
And it is also almost entirely wrong for the average person.
Completely wrong.
It's also largely outdated even for the professionals. Most of that high-speed trading happens on servers in New Jersey now, not by guys yelling at each other in Lower Manhattan.
That ruins the movie magic a bit.
It does. But for the individual investor, that Hollywood image is actually dangerous. What the source material really highlights is that the reality of true successful investing is actually much more mundane.
Mundane. That is the exact word they use. Ordinary. And I have to be honest, mundane doesn't really sell movie tickets.
It definitely doesn't, but in finance, mundane is actually the highest compliment you can pay a strategy. You really want mundane. You want boring.
Okay, hold on, though. I have to push back on that a little bit.
Sure.
Because when I think of winning at money, I think of the guy who bought Bitcoin at $1. I think of the person who got into Tesla right before the stock exploded.
Of course.
That is not mundane. That is incredibly exciting. And those people got rich. So why are we sitting here advocating for boring?
Well, because that is the trap. That is exactly the dopamine hit that the market uses against you.
Yeah.
Yes, those rare stories happen. But for every single person who bought Bitcoin at $1, there are thousands upon thousands of people who bought something else at an absolute peak and lost everything.
Oh, I see.
If your investments are exciting, it usually means you are taking on a level of risk that borders on just straight up gambling. The source makes a very clear distinction here. The goal isn't the adrenaline rush of the casino floor. The goal is building wealth over the long term.
So we are shifting the focus from get rich quick to get rich eventually and securely.
Precisely. If you are shouting at your computer screen, you are probably doing it wrong.
Good rule of thumb.
Real investing looks a lot more like a person sitting on their couch in sweatpants, clicking a mouse maybe 3 times, and then closing the laptop for 6 months.
That does sound remarkably un-Hollywood.
It is, but that behavior shift is exactly what separates the actually wealthy from the gamblers. It's not about shouting on a phone. It's about understanding the nature of the market itself. Which perfectly brings us to the zoology of Wall Street.
I really love this part. The animals, the source material spends a really good amount of time decoding why we actually talk about bulls and bears.
It's fascinating.
I mean, I've always known the terms. Everyone has heard them. But I never really stopped to think about it. Why a bear? Why not a tiger or a badger or something?
Right. Well, they aren't just random mascots for sports teams. These are very ancient metaphors for market sentiment. And sentiment, as they discuss, is just a fancy word for the collective mood of the market.
How the investors are feeling.
Exactly. Are they feeling good or are they feeling bad?
Okay, so let's break down the bull first. The bull market.
The bull market. So the imagery here is very specific to the actual anatomy and attack style of the animal. Think about how a bull fights. If a bull charges at you, what does it do with those horns?
Well, it gores you, I guess. It thrusts upward.
Exactly. It thrusts its horns up. It lifts things into the air. That upward motion is the absolute key to the metaphor.
Ah, okay. So the physical movement is upward.
Correct. A bull market represents an economy that is charging forward. Prices are rising across the board. The trajectory, meaning the path followed by the economy, is upward.
So when we talk about a trajectory, we aren't just talking about a straight static line.
Yeah.
We are talking about the momentum and the forces acting on it.
Yes. In a bull market, the trajectory is highly positive. Investor confidence is soaring. People are optimistic. They really believe things will just keep getting better.
Like the late 1990s.
Exactly, the dot-com boom. Or that long stretch right after 2010. Everyone feels like an absolute financial genius in a bull market because pretty much everything you buy goes up. It becomes this self-sustaining cycle of confidence.
Okay, so if the bull is the ultimate optimist, the party animal essentially, then the bear has to be the pessimist.
The bear is the downer, the party pooper of Wall Street. And again, you have to look at the physical mechanics. How does a bear fight? It doesn't thrust upward.
Right, it swipes. It stands up on its hind legs and comes down on you.
It swipes down with its massive paws. It crushes things toward the ground. So a bear market is when prices are falling.
And the source material actually gives us a very specific statistic here to define it right.
They do. It's usually officially defined by a drop of 20% or more from recent highs.
20%. I mean, that is a significant chunk of change. That's not just a bad day trading. That's a really bad year.
It is huge. Imagine just logging into your account and seeing you've lost 20% of your entire net worth in a few months.
Oh.
That is the true definition of a bear market.
Wow.
The context here is usually a recession or a broader economic downturn. Think about 2008. Or think about the very beginning of the pandemic in early 2020.
The outlook becomes extremely pessimistic.
People get scared, they panic sell, and that overwhelming fear actually drives prices down even further. Just like the bull market, it becomes a self-fulfilling prophecy, but in the opposite direction.
So the bull thrusts up and the bear swipes down. It's actually a really helpful visual mnemonic when you picture it that way.
It really is. And understanding which market you are actually in helps you manage your own expectations. If you know for a fact you are in a bear market, you know to expect that downward swipe.
Where you brace for it.
You don't panic nearly as much because you understand the nature of the animal you are dealing with. You don't try to pet the bear, you just wait quietly for it to leave.
But dealing with a bear market naturally brings us to the whole concept of risk. Because when that bear swipes, people genuinely get hurt financially. And the source brings up a fantastic idiom right here: losing your shirt.
A classic American idiom. It's one of those phrases we use all the time without thinking about the literal image it conjures up.
It is so vivid, though. You've lost so much that you literally do not even have the clothes on your back anymore. You are completely destitute.
It implies total financial ruin. And in the strict context of the source, losing your shirt means losing all your money in a catastrophic investment. And the root cause of that is usually volatility.
Volatility. That is a word that gets thrown around on the evening news constantly. You always hear markets are volatile today.
Right. And strictly speaking, volatility just means that something is liable to change rapidly and unpredictably.
So it goes both ways.
Yes, it can mean going up incredibly fast or going down incredibly fast. But in the context of losing your shirt, we are specifically talking about the downside, that sudden stomach-churning drop.
So how do we actually avoid losing our shirts? I happen to like my shirts. I'd like to keep them in my closet.
Yes, you should.
Emma and John discuss a golden rule for this. It's another idiom, actually, probably the most famous one in all of personal finance. Don't put all your eggs in one basket.
This is truly the cornerstone of modern portfolio theory, even though they are just using a simple old farm idiom to explain it.
The logic is pretty undeniable, though.
It is. If you carry every single egg you own in one single basket, and you happen to trip on a rock,
You have a giant gross omelet on the sidewalk and absolutely no breakfast.
exactly, you lose everything. No, in financial terms, the basket is a single individual company. The source uses Apple or Tesla as their primary examples.
And these are undeniably great companies, right?
Yeah.
I mean, everyone loves Apple products, so why shouldn't I just put all my savings into Apple stock?
Because even the greatest companies in the world can have terrible, catastrophic years. Or look at market history. Companies that were once considered completely untouchable have literally gone to zero.
Oh, like Enron.
Enron, Lehman Brothers, Kodak, Blockbuster. If you take every single dollar you have to your name and put it into just one of those companies, you are betting your entire financial future on the success of that one single entity.
That really does seem insane when you put it that way. But people do it all the time, don't they?
They do it constantly. They work for a tech company, they get a bunch of stock options, and suddenly 90% of their wealth is tied up in one single stock.
And if that one company fails, for whatever reason, you lose your shirt.
Completely. So the obvious solution is diversification. You simply need more baskets.
But practically speaking, buying thousands of different individual stocks seems like a massive amount of work. That goes right back to the shouting on the phone image we are actively trying to avoid.
Right, you'd be tracking earnings reports all day.
Exactly. Yeah. I don't have time to research 500 different companies. I barely have time to research what I'm having for dinner tonight.
And you shouldn't have to, which is exactly why the expert in our source material, Emma, introduces the modern mechanism for easy automatic diversification. She talks extensively about index funds and ETFs.
ETFs. That stands for Exchange Traded Funds.
Yes. And the specific golden example they give in the discussion is an S&P 500 fund.
So can you break that down for us? What is actually happening mechanically under the hood when I buy one share of an S&P 500 ETF?
Okay, think of the S&P 500 index like a giant smoothie.
A smoothie. I like this.
The index itself simply tracks the top 500 largest publicly traded companies in the U.S. economy.
So that's your Apple, your Microsoft, Amazon.
Yes, but also all the boring essential companies like Johnson & Johnson or massive waste management companies or shipping companies. When you buy one single share of an ETF that tracks this index, you aren't just buying one piece of fruit. You are buying a sip of the smoothie that literally contains all 500 fruits blended together.
That is a delicious analogy. So with one purchase, just one single click of the mouse, I own a tiny, tiny piece of Apple, a piece of Tesla, but also a piece of 498 other major companies.
Exactly. You effectively own a slice of the whole market. And here is why that matters so much for risk management. If one of those companies suddenly goes bankrupt, let's say company X goes to zero, totally implodes, it is just one tiny microscopic part of your smoothie.
Right.
It might make the smoothie taste a tiny bit bitter for a second, but the other 499 ingredients, the sugar, the strawberries, the bananas, they are still right there. The other companies are likely still doing just fine, maybe even growing and taking market share from the one that failed. They balance it all out.
It mitigates the risk. That's the exact word they use in the source. Mitigate.
Yes, to mitigate. To make a bad situation less severe, you are actively smoothing out the ride. Now, you might not become a billionaire overnight like you possibly could if you bet everything on a lucky lottery ticket stock, but you are also highly unlikely to ever lose your shirt. You've completely removed the risk of a single company destroying your life.
And this fits perfectly into that mundane strategy we talked about earlier.
Completely. Emma calls it set it and forget it. It is a strictly passive strategy. You aren't watching the ticker tape every day. You aren't reading financial reports. You just buy the whole market and you let the broader economy do all the heavy lifting.
You are betting on American capitalism as a whole rather than betting on whether the CEO of one specific company is going to make a good decision next Tuesday.
And when you set it and forget it, you are relying on something entirely different to generate that wealth. You aren't relying on your own brilliant trading skills. You are relying on pure math.
Which brings us to the eighth wonder of the world.
The engine of wealth.
The source attributes this famous quote to Einstein. Supposedly, he called compound interest the eighth wonder of the world.
It is a very powerful endorsement. Now, whether Albert Einstein actually sat down and said that or not is heavily debated by historians, but the underlying math absolutely holds up regardless. Compound interest is effectively earning interest on your past interest.
Which sounds simple enough when you say it out loud. Interest on interest. But can we make that a bit more concrete? Because I really think our human brains are wired to think linearly, not exponentially.
You are absolutely right. Humans are notoriously terrible at grasping exponential growth intuitively. Let's look at the rule of 72. It's a very common mental math trick in finance. You simply take the number 72 and divide it by your expected annual return rate. The answer gives you roughly how many years it takes to completely double your initial money.
Okay, let me try that. So if I get a 10% return, which is roughly the historical average of the stock market, right?
Roughly, yes, over the long term.
So 72 divided by 10 is 7.2. So every 7 years or so, my money doubles.
Roughly, yes. So really think about the implications of that. You put in $10,000 today. 7 years later, it's $20,000. 7 years after that, it's $40,000. Then it's $80,000. Then $160,000.
And I haven't added a single extra penny in this scenario.
Not a cent. But the jumps keep getting bigger and bigger every single cycle.
The jumps get bigger. That is the key to the whole thing.
The source uses a visual metaphor here that I think explains this exponential growth perfectly. The snowball effect.
Right. So imagine a snowball at the very top of a really long snowy hill.
You pack it together and you roll it down. Now, at first, it's quite small. It's the size of a baseball. It picks up a tiny little bit of snow with every single rotation.
It doesn't look like much is happening at all.
No, you might look at your account after a year and say, wow, I made $50. Big deal. This is useless.
But you have to leave it alone. You have to keep it rolling.
Exactly. Because as it gets bigger, the actual surface area of the snowball grows. With every single turn down the hill, it picks up significantly more snow than it did the turn before. By the time it reaches the bottom of the hill after 20 or 30 or 40 years, it is an absolute avalanche. It's massive. It's smashing through trees.
But the truly crucial ingredient in that metaphor is the length of the hill itself.
Time. The source heavily emphasizes the time frame of decades. Compound interest does the heavy lifting of wealth building, but it absolutely requires immense patience.
This is what everyone says starting at age 25 is mathematically wildly different than starting at age 35.
Oh, it's night and day. Those 10 extra years aren't just 10 years of standard saving. They are the final 10 years where the snowball would have been at its absolute biggest at the bottom of the hill, picking up the most snow per rotation.
So the mundane strategy is actually the most powerful strategy available to us. You use ETFs to simply diversify so you never lose your shirt. You avoid the bear by completely ignoring short-term volatility. And you just let the snowball of compound interest roll quietly for 30 uninterrupted years.
That is the complete recipe for success presented in the source. It is disciplined, it is entirely logical, and most importantly, it completely removes human emotion from the equation. It's boring and it works brilliantly.
It works, provided you actually get to keep all the money you make.
Oh, right.
And there's always a big but in life. There's another massive certainty we have to deal with in this system.
Here is the big shift in tone for the discussion.
Yeah.
We are essentially moving from the abundance mindset of investing to the scarcity mindset.
Yeah, the source material makes a very distinct pivot right here.
Yeah.
Emma says we finally have to address the elephant in the room.
Which is such a great idiom for a major problem or controversial issue that is just obviously present, but everyone is desperately avoiding talking about because it is deeply uncomfortable.
It's just sitting right there in the living room, taking up all the space, knocking over lamps, and we're all just sipping coffee, pretending it's not there.
And that giant gray wrinkled issue is, of course, taxes.
The inevitable burden, the friction acting against our beautiful snowball.
They actually bring in Benjamin Franklin here. In this world, nothing can be said to be certain except death and taxes.
It's a bit grim, isn't it? Pairing personal finance with our own mortality.
It is, but it really underscores the fundamental point. You simply cannot opt out. If you are participating in the American economy, if you are successfully making that money from the stock market we just discussed, you absolutely have to deal with Uncle Sam.
Uncle Sam. The classic personification of the U.S. government. The stern-looking guy in the top hat pointing the finger saying, I want you
to pay me a portion of your gains.
Right, exactly. And dealing with Uncle Sam, specifically the IRS, the Internal Revenue Service, is a truly unique experience compared to many other developed countries. I think this is something people really don't realize if they haven't ever lived elsewhere.
Oh, absolutely. In many places, say the UK or Japan, the government essentially just does your taxes for you behind the scenes.
Because they already have the data right.
Right. They track your income, they calculate what you owe, and they just send you a bill or they send you a refund check. You quickly check the math and you're done. It takes 5 minutes.
That sounds like an absolute dream, honestly. Here's the bill. Pay it and move on. Simple.
But not in the U.S. In the U.S., the entire system is built on this concept of voluntary compliance. The entire burden of reporting is placed squarely on the individual citizen. You have to actively file a tax return.
You have to sit down and tell the government, here is exactly what I made this year, and based on these complex rules, here is what I think I owe you.
Which is a bit bizarre when you really stop and think about it. The government already knows what you made for the most part. They have all the W-2 forms from your employer. They have the 1099s from your bank.
But they still make you guess. And if you guess wrong or do the math wrong, you get in serious trouble.
It's a simplification, but yes, essentially. It creates a truly massive administrative burden on the average citizen. And there is a very hard deadline for all this homework.
April 15th, tax day.
The source specifically says that date is etched in every American's mind. Like, it's literally carved into stone in our collective psyche.
It really creates a palpable national anxiety.
Oh, yeah.
Every single year leading up to mid-April, there is this frantic collective scramble. You see the commercials for tax prep software everywhere you look. People are digging through dusty shoeboxes looking for crumpled receipts. It is an annual stressful ritual.
And it is not just filling out a basic form with your name and income. It's navigating a highly progressive tax system. I think this is where a lot of smart people get genuinely confused. We hear about tax brackets all the time, and people get the underlying math wrong constantly.
Oh, the bracket misunderstanding is huge. I'm so glad Emma and John touch on this in the source. I've personally heard people say things like, I really don't want to take that raise at work or take that end-of-year bonus because it will actually bump me up into a higher tax bracket and I'll end up losing money.
I hear that exact phrase all the time, too. I don't want to make more money because the taxes will just eat it all and I'll take home less. That is a fundamental, total misunderstanding of how progressive brackets actually function in reality.
So let's explain the reality here. If I get a raise and I move from, say, the 22% bracket into the 24% bracket, does the government suddenly reach in and take 24% of all my money?
No, absolutely not. That is mathematically impossible in a progressive tax system. You have to think of the tax brackets as buckets.
Okay, buckets. Let's visualize that.
Your very first bucket. Let's say the money you earn from $0 up to about $11,000. That entire bucket is taxed at a low rate of 10%. Once that first bucket is completely full of your income, your extra earnings spill over into the second bucket. Okay. That next bucket might hold your income from $11,000 up to $44,000. And any money that lands in that specific bucket is taxed at 12%. But, and this is the crucial part, the money sitting in that first bucket stays right there and is only ever taxed at 10%.
So if I get a small raise at work that pushes me just one single dollar over the line into the highest bucket,
then only that one single dollar is taxed at the highest rate. The rest of your salary sits comfortably in the lower buckets, being taxed at those much lower rates.
so earning more gross money is always mathematically better for you. You never actually lose take-home pay by getting a raise.
Correct. Your marginal rate goes up, meaning the tax rate on your absolute last dollar earned, but your effective overall tax rate is just an average of all the different buckets combined. The source makes sure to clarify this so listeners don't actually fear career success. You don't jump entirely to a new ladder, you just step up one single rung with your new money.
Okay, that makes total sense. So that covers how the money comes in. We obviously want the money to come in. But the ultimate goal of the game, according to the source, is to legally lower the final number that the tax percentage applies to. We want to shrink the amount of money going into those buckets if we possibly can.
Right. We are talking about deductions.
Yes. The primary strategy of tax prep is to lower your taxable income.
Think of taxable income as the only number the IRS actually cares about at the end of the day. You might have a great job and earn $100,000 a year. That is your gross income. But if you can legally show the IRS, hey, actually, for tax purposes, you should only look at $80,000.
Then you save a ton of money. You're only paying tax on that $80,000.
Exactly. And you achieve that reduction through deductions. The source explicitly mentions two main paths you can take here. It is basically like a major fork in the road when you are sitting there filling out that Form 1040.
You have the standard deduction and you have itemized deductions.
Let's start with the standard deduction. This sounds very much like the mundane version of taxes we were talking about earlier.
It really is. The standard deduction is the easy button for your taxes. It is a flat, predetermined amount of income that the government just automatically decides not to tax at all. Congress sets this number every year. For a single individual filing in 2024, it's somewhere around $14,600.
So the first $14,600 I earn at my job is just completely free of federal income tax.
Effectively, yes. It just knocks your taxable income down by that exact flat amount.
Yeah.
You don't have to prove a single thing to them. You don't need to save any receipts. You literally just check a box on the form, and boom, a large chunk of your income becomes invisible to the taxman.
Simple. Clean. I like it.
Very simple. The vast majority of Americans just take the standard deduction and call it a day. But for some people, it is actually not the best financial deal.
And this is where itemizing comes in. This is for the people who really enjoy paperwork.
Or for people who have very specific large types of expenses during the year. Itemizing means you are manually listing out your specific allowable expenses to lower your taxable income piece by piece. You actually have to file an entirely separate form, Schedule A, and you list these things outline by tedious line.
What actually goes on that list, though? Can I list my weekly grocery bills? Or my dog's expensive food?
Definitely not, and please don't try to tell the IRS your dog is a dependent. They are very strict about what qualifies. The source highlights a couple of key examples. Mortgage interest on a house is a massive one, and also significant charitable donations.
So if you bought a nice house recently and you are paying a huge amount of interest to the bank every month, which, let's be honest, in the early years of any 30-year mortgage is mostly what you were paying anyway, or if you gave a really large sum of money to a registered charity, those specific dollar amounts might add up to a lot.
Right. And here's how the math decision works. You add up all the specific items, your mortgage interest, your charity, your state and local taxes up to a certain limit, maybe some extreme medical expenses. You get a final total number for all your items.
And then what?
And then you simply compare it to the standard deduction. It's a straightforward comparison. Is your itemized total number bigger than the standard deduction number?
So if the standard is $14,600 and my itemized list of mortgage interest and charity totals $20,000.
You itemize. You take the $20,000 deduction because it clearly lowers your taxable income significantly more. You save more money on your tax bill.
But if my itemized list only adds up to, say, $10,000...
Then you just throw the list of receipts away and happily take the standard deduction. You always selfishly choose whichever number saves you more money.
It sounds highly logical when you lay it out like that, but the source directly refers to this entire process as a bureaucratic headache. I really do get it. Just keeping track of every single donation receipt, every single mortgage statement all year long.
And the rules constantly change on you, too. The SOLT cap, the state and local tax deduction limit that changed drastically a few years ago and threw everyone's personal math completely off. The U.S. tax code is notoriously complex. That's the exact word they use, notorious, which usually means well known for being bad.
Like a notorious villain.
It is a villain to your free time and sanity. The U.S. tax code is thousands and thousands of pages long. It's incredibly dense. It's often contradictory.
Which perfectly explains why the source explicitly mentions that many people simply don't do this themselves anymore. They hire a professional CPA.
A certified public accountant. Or they use sophisticated specialized software like TurboTax to guide them through it. Because the underlying risk of getting it wrong is significant. You aren't just doing basic math on a calculator. You are actively interpreting federal tax law.
And if you interpret it wrong, or if you just guess, well, that brings us to the ultimate boogeyman of adult life.
The audit.
The audit. Just saying the word out loud makes my shoulders tense up.
The source legitimately describes it as a nightmare.
What actually happens during an audit, though? Is it like the Hollywood movies where serious agents and dark windbreakers kick down your front door and seize your files?
Usually not, thankfully. Usually it starts with a very terrifying formal letter in the mail just saying we have some questions about your return. An audit is an official, intense inspection of your financial accounts. It is a formal investigation. If the IRS thinks you're intentionally lying, or even if they think you just made an honest, innocent mistake like transposing two numbers on a form, they can audit you.
And then they start digging.
They dig deep. They want to see the physical receipts for those charitable donations you claimed. They want to see the official bank proof of that mortgage interest. If you chose to itemize your deductions, you better have the pristine paper trail to back up every single penny.
So that looming pressure, the sheer complexity of understanding the brackets, making the optimal choice between standard and itemized deductions, all while harboring this deep-seated fear of an audit, it all combines to make April 15th a very universally stressful time in America.
It creates a very strong, inescapable incentive to be compliant, to put the work in and get it exactly right. Because the penalties for getting it wrong can be incredibly severe. It can range from hefty financial fines to, in extreme cases of intentional fraud, actual jail time.
Okay, let's all take a deep breath. We have covered a truly massive amount of ground here today. We have these two massive, distinctly different worlds we've explored. The fast-paced world of Wall Street with its charging bulls and swiping bears and compounding mathematical snowballs. And then the bureaucratic world of Uncle Sam with its progressive buckets and complex deductions and terrifying audits.
And the source material actually does a beautiful job of weaving all these specific idioms together right at the end of their discussion. It elegantly synthesizes the vocabulary into a cohesive narrative. It's almost like a hero's journey, but for personal finance.
Let's look closely at that narrative they build. It always starts with taking the plunge.
Right, taking the plunge. That means committing yourself to a very challenging course of action. You stop sitting safely on the sidelines hoarding cash. You finally open that brokerage account. You take the plunge into the scary waters of investing.
But you are smart about it. You aren't a cowboy trying to get rich by Friday. You desperately want to avoid losing your shirt in a highly volatile, unpredictable market.
So you strictly follow the golden rule. Don't put all your eggs in one basket. You buy the broad ETF.
Yeah.
You buy the whole blended S&P 500 smoothie, not just the single volatile fruit.
You calmly watch the long-term trajectory of the bulls and bears. You understand that the bear will eventually swipe down and cause a recession, but you don't panic and sell because you fundamentally know the bull will eventually charge back up. You patiently rely on the snowball effect of compound interest to build your wealth silently over decades.
And then inevitably every single spring you face the elephant in the room.
Uncle Sam. The big gray demanding elephant.
You carefully navigate the progressive tax brackets, realizing that stepping up a rung is always a good thing. You maximize your legal deductions by intelligently choosing the standard or itemized path. And you try desperately to avoid an audit by keeping your nose clean and your receipts organized.
It really is a complete language. When you start to string those idioms together sequentially, you are telling the exact story of an American financial life. It is a lifelong story of balancing risk-reward and government regulation.
And that is the true empowerment the source really wants to drive home. Truly understanding these terms, ETF, tax bracket, itemized deduction, bull bear, it legitimately puts you miles ahead of the competition.
It allows you to make informed, prudent decisions for your family's future. That is the ultimate goal here. We aren't trying to magically transform everyone into aggressive hedge fund managers. We just want to be competent adults who don't go completely broke because we misunderstood a basic rule.
Precisely. You aren't just blindly reacting to money anymore. You are deeply understanding the mechanism behind it. You are finally looking under the hood of the car and actually knowing which wire goes where.
So what does this all actually mean for us as listeners? We've unpacked the dense vocabulary, we've looked at the underlying structures. What is the takeaway?
I think the big takeaway, and the source definitely alludes heavily to this, is that personal finance in the U.S. is intentionally designed to be participatory. It is not something that just passively happens to you while you sleep. You have to actively choose your investments. You have to actively file your complex taxes. You are forced to be an active player in the game.
That is a remarkably great way to put it. You simply cannot sit on the sidelines.
You really can't. Because if you sit on the sidelines of investing, hidden inflation will quietly eat away all your savings. And if you sit on the sidelines of taxes, the IRS will eventually come after you for not filing your returns. You have to play. There is absolutely no opt-out button for the American economy.
And learning the actual rules of the game is the necessary first step to winning it. Or at the very least, not losing your shirt in the process.
Absolutely.
It really makes you think, though. We started this whole deep dive with the romantic idea that compound interest is the eighth wonder of the world.
The fun wonder. The mathematical magic trick that quietly makes you rich while you sit in sweatpants.
The fun wonder, but maybe, just maybe, the sheer staggering complexity of the U.S. tax code is the ninth wonder of the world.
The significantly less fun wonder. The towering wonder of endless bureaucracy. The paperwork labyrinth.
Just a much less pleasant labyrinth to inevitably get lost in every April.
It does raise a really interesting question for you, the listener, to take away from all this, actually.
Yeah.
A bit of a philosophical nugget to chew on as we wrap up. Well, in a system exactly like this one, where you are entirely responsible for building your own financial safety net through active investing, mostly because guaranteed corporate pensions are basically extinct now, and you are solely responsible for calculating and reporting your own complicated earnings to the government through filing a return.
Right.
Does that dynamic make you a true empowered partner in your own governance?
Yeah.
Or are you effectively just an unpaid forced accountant for the state?
Oof. Now that is a truly provocative thought, an unpaid accountant for Uncle Sam. I think a lot of stressed out people feel exactly that way on April 14th at 11 p.m. when the official tax website inevitably crashes.
I heavily suspect they do. But at the end of the day, whether you feel like an empowered partner or just a frustrated unpaid employee, you still have to hit submit on that form.
Very true. Well, on that somewhat sobering note, we're going to wrap up this deep dive for today. Hopefully you all feel a little more like a confident charging bull and a little less like a panicked deer in headlights when it comes to navigating these topics.
Keep that financial snowball rolling down the hill. And definitely keep your receipts.
Exactly. Thanks so much for listening, everyone. We will see you on the next deep dive.
Goodbye.